Welcome to our comprehensive guide to best practices for Fidelity Index Funds. Investing in index funds can be a great way to diversify your portfolio and potentially earn long-term returns. First, it is essential to understand what index funds are. Index funds are a type of investment that tracks a specific market index, such as the S&P 500. They aim to replicate the performance of the underlying index by holding all or a representative sample of the same securities. Fidelity offers a wide range of index funds that cater to different investment goals and risk tolerance. When selecting a Fidelity Index fund, consider your investment objectives, risk tolerance, and time horizon. Look for funds with low expense ratios, as they can help you save money on fees over the long term. One of the best practices for investing in Fidelity Index funds is to adopt a long-term perspective. Historically, the stock market has provided higher returns over the long term, despite short-term fluctuations. By holding onto your investments for an extended period, you can ride out market volatility and potentially benefit from the power of compounding. Another key concept is diversification. Spread your investments across different asset classes, such as stocks, bonds, and international markets. This can help you manage risk and increase potential returns. Fidelity Index funds offer a convenient way to achieve diversification, as they provide broad exposure to various markets and sectors. In terms of practical examples, consider the Fidelity 500 Index Fund, which tracks the S&P 500 index. This fund provides exposure to the U.S. stock market, with a low expense ratio and no minimum investment requirement. Another example is the Fidelity Total Market Index Fund, which tracks the U.S. stock market and offers broad diversification. When investing in Fidelity Index funds, it is crucial to maintain a disciplined approach. Avoid making emotional decisions based on short-term market movements, and instead, focus on your long-term goals. Consider setting up a regular investment plan, where you invest a fixed amount of money at regular intervals, regardless of market conditions. Finally, keep in mind that past performance is not a guarantee of future results. It is essential to monitor your investments periodically and rebalance your portfolio as needed to ensure it remains aligned with your investment objectives. By following these best practices and maintaining a well-informed approach, you can make the most of your investments in Fidelity Index funds and work towards achieving your long-term financial goals.